Good afternoon, everybody. Welcome to my channel, where I'm going to talk about everything related to taxes, international taxes, and business. And in today's video, I am going to discuss the tax implications of hiring an overseas employee from a United States employer. This is a topic that's become more relevant in recent years because more and more businesses are looking for talent beyond their borders, and they are taking advantage of the global workforce. So, before we dive into the details, just make sure to hit the like button and subscribe to my channel for more videos like this. And if you have any questions or comments, leave them below and I'll try to answer them as soon as possible. So, what is an overseas employee? An overseas employee is someone who works for a US employer but lives and performs their services outside of the US. This could be still a US citizen or a resident alien or a non-resident alien, and the tax treatment of these employees depends on their citizenship, their residency, and the location of their work. First of all, what are the tax implications for the employer, you, the U.S. employer? As the U.S. employer, you may have to deal with various tax issues when hiring an overseas employee, such as thinking about your corporate income tax, the employer's payroll taxes, possible employee income tax withholding, and then of course your reporting and your compliance obligations. So let's look into each of these issues in more detail. First, corporate income tax. There's a risk as a U.S. employer when you hire an overseas employee that may create a taxable presence or a permanent establishment in a foreign country where the employee works. Permanent establishment is generally defined as a fixed place of business through which the business of an enterprise is carried on. That could include an office, a factory, a branch, or an employee's home office. So if you do create a permanent establishment in a foreign country, you might become subject to corporate income tax and compliance obligations in that country on any income attributable to that office. That could result in double taxation if you have to pay U.S. corporate income tax on that same income. But to avoid or reduce that double taxation, you could be able to claim a foreign tax credit or an exemption for the foreign income on your U.S. corporate income tax return. That is going to depend on the details of the U.S. tax treaty, if the U.S. even has a tax treaty with that foreign country. And then there'll be some requirements and limitations. So you always have to understand the tax rules and study the tax treaty of that foreign country where your overseas employee works, and then plan accordingly. Payroll taxes is another issue. When you hire an overseas employee, you may have to pay payroll taxes in that foreign country where the employee works. That could include Social Security contributions, unemployment insurance contributions, workers' compensation insurance, other taxes. Now, these rules vary from country to country and depend on a variety of factors, but once again, there could be a tax treaty between the U.S. and this foreign country, and you also want to look for a Social Security agreement between the U.S. and the foreign country, and then of course the citizenship and the residency status of the employee. Generally speaking, if you do have this permanent establishment in this foreign country, then you probably will be subject to employer payroll taxes. If you don't have the permanent establishment in the foreign country, you still might have to register with the local tax authorities and operate a payroll system. But you should check with your international tax accountant or a local tax professional from this foreign country. Then there's another issue, which is employee income tax withholding from the U.S. So as a U.S. employer hiring an overseas employee, you may need to withhold federal income tax from the wages, U.S. federal income tax from the wages paid to this employee. So these rules are once again going to depend on whether this employee is a U.S. citizen living abroad, a resident alien living abroad, or perhaps a non-resident alien with no connection to the U.S. If this employee is a U.S. citizen or a resident alien, permanent resident, or some other form of residency status in the U.S., then you generally will have to withhold federal income tax from their wages. There are some exceptions, but generally you will have to do that. If the overseas employee is a non-resident alien, you generally will not have to withhold federal income tax because those wages are considered to be foreign source income and they're not subject to U.S. federal income tax. Of course, if that employee does perform some of their services inside the US, they may travel to the US or live here temporarily, then they would need to have some tax withheld off their checks during that time. Finally, there's reporting and compliance obligations. So when you hire an overseas employee, you may need to report that on various tax forms and information forms in the US, and of course also in the foreign country where this employee is working. So some of the most common ones are W-2 wage income, wage and tax statements for any wages subject to US federal income tax, and then of course the quarterly tax returns to submit those withholdings to the government. You may have to file a 1042 or a 1042-S, which reports withholding taxes for U.S. source income, any payments to non-resident aliens where you've had to withhold taxes for some reason. You might need to file a 5471 return for owning or controlling a foreign corporation with a permanent establishment in a foreign country. You may need to file a 5472 if it's a foreign corporation with a permanent establishment in the U.S., so that's kind of the other direction. There's a Form 8858 if you have a disregarded entity in a foreign country. And there's a variety of other forms as well that you need to report. Even the Form BE10, which is a benchmark survey for U.S. investment abroad, if you're owning ownership or more than 10% of the voting stock of some foreign enterprise. So the reporting and compliance obligations that you have in these foreign countries depend on the tax rules and requirements of that country. They vary from case to case. You should always consult with a local tax professional or an advisor in the foreign country where your overseas employee works. If you want to reach out to me, I have experience in quite a number of different countries, and also I have a vast network of advisors and professionals in all these different countries. So you can see that having an overseas employee from the U.S. Can have significant tax implications both for you and for your employee. You do need to understand these implications before making any hiring decisions. On a personal note, I've worked with overseas. We have had overseas employees off and on for quite a number of years here at Goosen CPA, and we've always found it to be a benefit. It's great to work with these people. Labor costs are obviously lower in quite a few circumstances, and once you deal with the compliance, it works really great. Thank you.